Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-host for Upticks.
Today is our 34th episode, Cash and Checks.
We're talking about tax refunds, questions worth asking, and REITs.
Okay, Corey, with tax season fast approaching here, we wanted to talk to our viewers about what they should do if they do get a big check in the mail from the IRS as far as a refund is concerned. So if they file their taxes in April or March or whenever they do it, and they get a big check, what should they go do with that? Should they go to the boats and gamble it away, or what would you suggest for a client that got a big refund?
I wouldn't recommend that.
You wouldn't recommend they go to the boats?
Well, not. I wouldn't probably go to the boats and spend the whole check there. I mean, I guess if it's just purely disposable income that they're not relying upon, go ahead, I guess. But maybe they'll double it up. Probably not, though.
Okay. So what would your advice be?
So my advice would be, if you're, for instance, I hear commonly from people that say, I don't feel like I have as much money as I'd like to have in like my cash reserve, for instance. Or my emergency savings was depleted because Christmas just came. I had to pay the credit card bills. My personal property taxes, et cetera, were due. And, people need a little bit of extra cash. And it doesn't mean that you shouldn't enjoy some of that money, right? I mean, if you're getting money back, that's not a paycheck. It's not necessarily something that you planned on. The idea is I wouldn't necessarily see it as free money, right, or money you weren't expecting, because it is your money that the government held throughout the year, and they're paying it back to you.
That's a good point. And again, of course, none of this is supposed to be specific advice for someone to go and take, but so what you're recommending is maybe build up an emergency fund.
Yes, at least with a part of it.
Which is a lot of people, that's boring though.
Yeah, I know.
So what I would probably recommend is to take a look at my future withholdings also.
Yes.
So not only build up maybe a cash reserve, but you shouldn't be getting $10 or $15 or $20,000 back from Uncle Sam. That means that there's an error in your withholding, and you should probably start looking at doing some tax planning with your CPA to figure out where you're withholding and why you're withholding the rates or the amounts that you are.
Exactly. Because go ahead.
So what I was getting at is, yes, you should probably use some of that to maybe pay down some debt or build an emergency fund, but you also want to tweak that so that maybe you can take home more money per paycheck versus getting a larger amount at the end of the year or the following year when tax time comes.
And I think it's particularly important if somebody's retired and they're taking distributions from their IRA, for instance, where you're withholding taxes at the time of the distribution. Because one, not only are you paying the government money that you're going to get back later, but two, you're not getting the benefit of that money staying in your account, compounding throughout that year. You're much better off keeping that money in your own account and keeping it invested versus taking it out and giving it to the government where they're not paying any interest on that.
Right, absolutely. So, I think what you're getting at here is even if you had it in a bond paying 3% or whatever it is, that's much better than Uncle Sam having it and you're not earning any money on that. And so, again, none of this is official advice, but something that I would look at is, one, if you get a bigger refund than you were expecting, the prudent thing to do would be to certainly build an emergency savings, pay off any credit card debt. I also, most importantly, would review my withholdings and make sure that I'm not withholding too much throughout the year. And then also, worst case scenario, if you want to go to the boats, have fun with it, right?
Right. And I'm glad you said that, because we're not, a couple of, stodgy guys saying, it has to be for some disciplined financial objective. My point is just that, understand that that is your money. And if you pretend that was your money throughout the year, would you have gone to the boats and spent
That's a very good point.
Probably not.
But if you were planning on maybe taking a vacation and you wanted to use that money for that, then so be it.
Agreed.
Then go ahead and use it. Or maybe buy a TV or whatever that may be.
Yes.
So that's good. So again, theme of our show today is cash and check. So again, certainly cash that check, get that refund from Uncle Sam, but just be smart with it. And then definitely you probably shouldn't be getting big refunds back. That's not really what... in our opinion, that's not really making good sense of what the IRS is there to do.
Correct.
Okay, good. So to our next segment today, we always like to throw questions at each other as far as maybe what some of our clients have been asking us lately. So I'll let you start. What question do you have for me of something that maybe you thought of or that certainly a client may have asked you lately?
Just last week, a client shared with me a story about a friend of theirs that had this particular instance occurs. And ultimately they felt like they could have avoided this. So my question is, for you, Jake, what type of impact does taxable income have on my Medicare and prescription drug costs?
Oh my gosh, you might have stumped me. So the question was taxable income. How does that impact my Medicare costs?
Yeah, specifically if I were to take a big distribution from my IRA this year, for instance.
Oh, from your IRA.
Yes. What impact would that have on my healthcare costs next year if I'm already at Medicare age?
Now, I could be wrong. So the way I'd answer this question is I would probably seek out a healthcare professional to give me official guidance on this because, again, we don't dabble in Medicare directly. But I don't think IRA distributions impact Medicare, do they?
They do.
They do? Okay.
It's taxable income.
Gotcha. So I get it, but it's not earned income, but it still counts towards Medicare?
Yep.
So how does it, you stumped me, so maybe you can answer the question.
Well, and it was a good question.
It is a really good question.
There's effectively, so to answer it though, there's basically a table of different, if somebody's in a certain income range, their Medicare Part A premiums cost X dollars. But the higher your taxable income is that's reported to the IRS, right, regardless of where it comes from, Social Security is part of it, IRA distributions, part of it, pensions, et cetera.
So if you're 65 or older and you're on Medicare is what Corey's talking about.
The higher your income is, the more your Part A premiums are going to be.
Okay.
And the more your prescription drug costs are going to be. So the idea there is, now it's capped. There's a point where there's a max dollar amount that someone can pay. And I don't know if I believe it went up a little bit in 2019. It's in the neighborhood of around $430 to $435 a month.
Gotcha. Well, that's good to know. So it does get capped out.
It does get capped. But if somebody, for instance, like this particular person took a big chunk of money out of their IRA to pay off their house because they just wanted to be done with a mortgage, which psychologically I understand that. They didn't know, though, when they did that, the type of impact it was going to have on their health care costs the following year because they had to report that income.
Gotcha. So what happened? They realized that their Medicare was higher.
They have to eat the bigger costs.
Now, does it readjust every year?
I think so.
Okay. Interesting. So if you are planning on taking out a big distribution from your IRA, I guess the lesson from this is maybe you can bridge that over a couple of years to certainly maybe avoid your Medicare Part A going up.
Yeah, and just understand
that it could go up.
Understanding the impact that it could have. That it's not just impacting your taxes for that year, but it might impact other costs, future costs that you have, like healthcare.
Right. And so again, it's important to maybe work with your tax professional as well as whomever's helping you with Medicare on that one. So good question.
Thanks.
I'm going to have to stump you next week.
All right.
So a hard one's coming your way. Today, though, I did give you a little bit of a soft one, so softball. So my question for you is, my company just offered a buyout, right, or a voluntary separation package, a VSP. What do I do?
It depends. I know that's a not a cop-out answer, but it does depend upon a number of things. One, what I would evaluate if your company provided an offer like that is, one, prior to that, what were your long-term retirement goals, right? Were you planning on working 1 more year, 5 more years, 10 more years, 15 more years? It's just at least something to take into consideration. Two, if you were to take and accept that buyout offer, then what are you going to go do? Are you going to go work somewhere else? Is this the actionable item that says, you know what, I need to go ahead and retire? This is a sign that it's time for me to go. And that happens occasionally. People are planning on retiring within a year or two. They get a buyout offer from their company.
Yeah, I'd say those are probably the best instances when you're a year out and you were going to retire, let's say in 2020, and then this thing falls on your lap or hits your email. That's a great windfall. I think you're going down the right path, though, as far as it's not only just a financial decision, it's an emotional one also, because what I've been meeting with a lot of clients lately is they weren't ready for this. And I'm not going to be one to ever talk somebody into retiring. That's not really our role.
Right.
All we do is really tell them financially if it makes sense or not. We can give them guidance around, hey, what are you going to go do? It's Tuesday at 8 o'clock. You're not at work anymore. What are you going to wake up and go do? Because it could be a pretty scary deal if you're not ready for it. And so because a VSP comes your way doesn't necessarily mean you need to click the button and take it. I think the most important thing, like you started with, would be to review your financial plan and then talk about it. If you're married, talk about it with your spouse. Is your spouse going to keep working?
Yep.
Are they going to retire also? Or maybe they're going to work a couple more years and then, maybe you'll go get a new job doing something fun for a couple years while you wait for them to retire. But it's definitely a lot to think about. The most important thing you can do, though, is work with a professional like Falcon Wealth Advisors. We've been through a lot of buyouts. We understand the intricacies and the complications that pop up with it. and we're here to help guide you through that. Another big one is health insurance. If you're 55 years old, you've got to bridge health insurance for 10 years if your company doesn't provide it, right? And you can get COBRA for 18 months, which is nice, but after that, you're going to have a plan or some sort of budget in place to make sure that you can afford health insurance.
Exactly. I was going to say understanding what those costs are going to be, because they're probably going to be more significant than what you've been used to while you're working.
But it's exciting, I would say. They're fun meetings, and so you shouldn't be stressed out over it. It's definitely an exciting thing. Who wouldn't like to get $100,000 to retire?
Sure.
Most of the time when you retire, you don't get anything.
Right.
They maybe give you a
pat on the back,
a party, and maybe they take you to a barbecue or something.
Coffee, whatever. Yeah.
But so to walk out of your employer for 30 years with a check for $100,000, not a bad deal. But again, it doesn't make sense for everybody. So I like the beginning of that. It does depend on your situation. We have clients that take them, we have clients that don't, and that's okay.
Be pragmatic and analytical and understand the financial piece of it, but also don't discount the emotional, the gravity of the decision that you are making. It doesn't mean, somebody's going to give me a big chunk of money, I need to hurry up, check the box, and get out of here.
Right.
Just pump the brakes.
Slow down.
Yeah, slow down.
Yeah, slow down. The money can be great and all, but we definitely have to make sure that you're ready for it emotionally.
Exactly.
Okay, good. So good job on that. You stumped me, and I think I missed on yours a little bit.
This video is a success.
Well, maybe for you. So the third topic today on our investment theme is REITs. Why don't you define what a REIT is for our viewers?
A REIT is a real estate investment trust.
Okay.
It is.
What does that mean?
So it's a type of security. There's different types of REITs which we can get into. But the idea is it's typically a specific type of real estate investment where distributions need to be made from that type of investment, where at least 90% of the distributions need to be returned to shareholders as typically in the form of dividends.
So what kind of real estate are you talking about? Are you talking about land? Are you talking about property on the plaza? Are you talking about homes? What are we talking about here?
So it's typically going to be not resident. Well, it could be residential. If it could be like apartment buildings, for instance, there might be a real estate investment trust that invests in or owns a number of apartment buildings, mini malls, movie theaters, office complexes, etc.
So basically, a REIT is also anything that is going to pay rent. Typically,
it's a good point. Yeah.
Right. So the idea is that rather than you go personally buying an office building and dealing with tenants and contracts and lawyers and accountants and setting up a business, you actually can just go and invest in the REIT itself. Now, there are different types of ways to get into REITs. You can use a mutual fund. You can buy something that's called an illiquid REIT, or you can go on the stock market and buy shares of a publicly traded REIT, which is the way that we do it. So to talk about the way we do it, so again, rather than us go open up LLCs for clients or deal with all of that, you simply can buy shares of the REIT, and then the REIT takes the income that they get from rent and they distribute that out to the shareholder in the form of a dividend. And how much of the rental income needs to be distributed?
At a minimum, 90%.
Right. So the good news is, so I guess some of that they'll keep to manage the REIT itself, or probably to pocket, perhaps.
Yep.
Right. So the idea is that these companies are established. They go out, they buy all these mini malls or shopping centers, they package them together, they become public, they take that rental income and then they kick it back out in dividends to the investors.
So I guess as sort of a follow-up piggyback question to that for you, what would be the sort of benefit, I guess, to having real estate in a portfolio?
Very good question. So the reason that we use REITs in our portfolio is because they're not perfectly negatively correlated, but there are. And what I mean by that is that if the stock market goes up, it doesn't mean that REITs will go up or down. They're basically act independent of each other. So we use it as an asset class to further diversify the portfolio is why we do it. So it's kind of like why we own gold. We also own oil. We have REITs. We also have large stocks and small stocks and international stocks. And so REITs just make up one piece of that colored box chart that we talk about called the Kalan. It basically represents a box on there, and we'll put that on the screen here. We like to show that chart. So REITs will be in that box, and you can see that box goes up and down based on what the REIT cycle does. But again, we buy them because we like dividends because it's income, and then we also buy them because it's another diversifier in a portfolio.
Makes good sense. Cash flow diversifier.
So sometimes clients will ask us, do I need to go buy real estate as part of my portfolio? And my immediate answer is, well, we have that in there already. But a lot of times clients will go buy rental properties and rent them out themselves as maybe part of the hobby that they enjoy doing.
Yeah.
Something personally that I don't want to get into because I don't want to deal with tenants and them trashing my property or mowing the lawn or shoveling the driveway or whatever you need to do. So just know that we understand the value of having a diversified portfolio with real estate in there. And that's what we do. We do it. We just do it through the stock market, and we buy publicly traded REITs for our clients.
That's good.
Did you want to add anything to that?
I don't think so.
Okay, good. So for our fun global topic today, hopefully I can throw a curveball at you, is why don't you share with our audience, maybe we've talked in the past about one of the best financial decisions you've made. Do you have anything you want to share, maybe a lesson that you've learned, maybe one of the worst financial decisions you've made?
Sure. While there's not something that, I guess from a personal finance standpoint, there's not necessarily something that jumps out. Well, actually, I take it back. I think I do have an instance, and it was years ago, and I sort of parlayed this in the previous conversation or a previous episode about how it turned into being a wise decision. But I was in a scenario shortly after I graduated college, frankly, when I had first started working, and I had an idea of what my lifestyle should be like at that point in my life. And the income wasn't quite there yet, but I didn't want to sacrifice, not being able to do the things that I wanted to do.
So what did you do? You lived off a credit card?
No, but I lived outside of my means. I did to the point where I didn't have the appropriate emergency fund saved up that I should. The recommendation I would make to somebody, I didn't have myself. Now this is, again, very early in my career, but it's true. And, I could pay rent, I could buy groceries, etc. But there were still things that I would go and do that if I didn't think that there was going to be enough money, well, I have a credit card, right? And it's not a wise thing to do. And it's something that a lot of people fall into. And, for a lot of people can really get out of control. But in hindsight, I can look back on that now and I understand the value at this point in my life of living within my means, ideally living below my means, which will put me and, a lot of our clients that are in positions where they're successful from a financial standpoint later in their lives is because they made sacrifices, they saved with discipline, and they didn't live outside of their means throughout their careers.
Gotcha. But you've done something to solve that sense, right?
Yes. Yeah, absolutely.
So you've consolidated your debt and you're paying that back.
Yes.
Not a bad lesson, but I don't think you're too bad off.
No.
I don't feel sorry for you.
No, I'm not looking for pity. I'm not looking for pity by any means. But I mean, if you ask me to share, that's something that in hindsight I could say that wasn't probably very smart.
So you would say somebody fresh out of college to just be patient, and maybe it's okay to live on a little bit tighter of a budget because ultimately things will blossom if you work hard in your career and you'll be able to afford those things. But there's no reason to go out and live off a credit card.
Right. And don't forget to start saving. Fortunately, I at least had the discipline to know to do that, obviously. Start putting money in my 401k. Let it start growing and compounding. But a lot of people don't do that either.
Well, that's funny. That's my answer, basically, is right out of college, my first job, I didn't start in finance originally.
Right.
And I had student loans, I had rent. And, I used the quote-unquote, I can't afford to put money in a 401k. And not that I did it for a long time, but I didn't start saving soon enough. So you're right, I didn't use compound interest to my favor. Now, since then, I've done a good job of catching up with my investments, but it would have been nice when I was 22, 23, 24 years old to be putting a little bit more in a 401k plan or in a Roth IRA, especially a Roth, because now I'm over the limits of a Roth and I can't even contribute. So that's a big lesson. Maybe some of our younger audience is saying, hey, if you fall in the limits to be able to contribute to your Roth, you definitely should be doing it, because if you do have a career where you're fortunate to one day make more money than the Roth IRA allows, you can't get in it. My Roth IRA is comical how small it is. I have one because I started one, but it's never going to be huge because I didn't put enough money in it when
now you can't.
Yeah, now I can't. So I wish I would have maybe, but again, I don't regret it because I've caught up. But it would have been nice, probably looking back, to maybe put a little bit more away earlier. But again, I've been able to catch up, which is nice. But it's probably one thing that I probably would have done differently if I had to do it all over again.
No, that's good.
But again, no regrets.
Right. No, there's a quick one that I'll share that I do regret. And that is maybe because it might be productive for people to hear. But there's been a couple of instances where I've tried to speculate on individual stocks before earnings, like specifically where if a company reports its earnings at the end of the day, like after the market closes, there's been certain companies where I've tried to buy that stock that day before they report earnings, thinking that it's going to do well, and it's done the opposite. And again, we're not talking a huge sum of money by any means, but every time I do that, I shouldn't say it hasn't been that many times, but there's been a couple. And each time I've done that, I recognize after that, this is why I should stick to having a diversified portfolio. Right. The companies that I know, that we invest in, that our clients are invested in. That we're watching closely. And, don't try to, getting rich quickly just doesn't work. It's the reality there. And it's not that that's what I'm trying to accomplish.
Right, but, you're speculating.
Trying to make a quick buck.
So lessons learned, don't live off your credit card right out of college. Save. You'll think, I'm 37 years old now. When I was 27, 25, I should have been putting probably more away than I was. If maybe I wasn't putting anything. And then there's no, don't be buying penny stocks or things right ahead of the earnings, thinking that you're going to time it just right or get lucky. I mean, you might happen, but it's not. The way to make money is consistently save, stay diversified, understand what you own and why you own it, and keep your fees low.
Yep, and keep your emotions out of it.
Yep, keep your emotions out of it. So that's all the time that we have for today's show. So thank you all for tuning in. As always, you can find us on various social media outlets. We're on Instagram, we're on Twitter, we're on Facebook, we're on LinkedIn. Certainly this is our YouTube channel. And again, you can find me personally on Twitter at Jake Falcon CRPC.
And my Twitter handle is @CoreyBittnerKC.
Thank you again, and we all hope you have a great week.